Let's talk about evaluating advisors. And let's talk about, what it is that you should look for when you are thinking about hiring someone. This is going to be both consultants and investment advisors, actuaries, audit firms, etc. First of all, you should know what you expect and what your standards are. Do you want everybody to be a Ferrari? Okay, fine. You got to be willing to pay for a Ferrari. Are you wanting everybody to be, a great Ford truck? All right. If so, that's fine. Know what your standards are and what you expect from every provider, and then ask the right questions. Now, this is where a lot of people get bogged down. What are some of the right questions? You'll see a theme here around conflicts and alignment. Well, what are the embedded conflicts? So that I'm clear, if you're recommending this to me, are you being paid to do so? If you're recommending this to me, are you getting any other form of benefit? It's a very fair question. A lot of people are like, well, that feels kind of rude. No, it's your job. Ask the tough questions. Ask them what it is that they are conflicted on. You hope to hear the answer of, we have no conflicts. We simply think this is the best thing for the plan. And if they do have a conflict, that doesn't mean it's a bad recommendation. Just know that, go into it with your eyes open, so that way you can make the best decision knowing those conflicts exist. Is it a proprietary product? Is it sold by a particular company? This is where, if you have a consultant who works for an investment firm, do they also get paid more to sell a proprietary product? Or do they simply say, yes, I am conflicted, but I really think this is the best thing and I make no additional money because of it? You just need to know the answer to that question. Again, doesn't make it a bad recommendation. Just know what you're getting into. Any fee sharing arrangements. The other thing is to look at persistency. Now, I will tell you, having been in the industry for as long as I have, this is the biggest mistake that I see allocators make. They chase the hot dot, right? The most recent best performer, they pile money into that. And then when it becomes a cold dot, they jump and they go over here and then they go over there and they're chasing their tails, and goes back to that proverb of, he who chases two rabbits catches none. You need to look for persistency. Who has delivered the most consistent good returns, not just the best returns for a flash and then the worst returns for a flash? Who has been the most persistent? Because as you think about a 20, 30, 40, 50-year time horizon, you want to make sure that you are delivering consistent performance against your target that you have for your plan. You also need to know how volatile things have been in order for them to get the results that they've received. Comparing two managers that have both delivered 13% returns, if one is, jumping around like a jackrabbit, and the other is very, very consistent and steady, it's a very different animal. You want to go most of the time with the persistent returns that are not as volatile, not just the hot dot who's been all over the place and might very well be the worst dot next year. You also should look and see how long have they done. Good example, it gets into a little practical application. If you're looking at a credit manager, you should know, were they around during the global financial crisis and how did they do in that environment? If they weren't, that doesn't mean that they're a bad firm, but you know that they've never been through a true bad environment for credit. Yeah, they may have gone through 2020, which was a flash in the pan, difficult environment. 2022, which was a difficult environment, but nothing like the global financial crisis of 08, 09. You need to know what it is that they did when literally everything was going wrong, just the same as you need to know how they did when everything was going right. And that is true for all asset classes: equities, bonds, stocks, private equity, private credit, etc. Have they been successful in both good and bad environments? Goes to the point of, would you rather chase the one who's always the best in a good environment and always the worst in the bad environment, or somebody who's been really solid in both good and bad environments? Again, with a long-term horizon, persistency is the most important. And also make sure that people are not learning on your nickel. I've seen this happen. I won't give any names in a couple of plans in Texas, but they got bit in the tail because the fact that they went with unproven managers that were kind of trying to figure it out. And then when things went south, They didn't figure it out very well. And then they went out of business. Well, you need to be with someone that's been around the block, been through the environments that are likely to be experienced over the next decade or two, and that they're not just figuring it out using your nickel. From there, did I mention alignment? I probably did. Alignment is everything. The more aligned you are, the better. The other thing you want to do is to use all the resources available to you to evaluate an advisor. Again, in the investment world, this is a little bit easier. In the advisor world, actuaries, audit firms, consultants, etc., it's a little more difficult, but you can still look for red flags there too. So first thing is you can use regulatory databases like BrokerCheck from FINRA or the SEC advisor disclosures. You should click on that before you even consider taking a meeting of who is it that I'm meeting with. Are they a good person? Are they a bad person? Did they have one mistake 35 years ago? Or are they consistently in trouble? Well, that probably should affect your decision. You should do background checks on the firms and the key personnel you're going to work with. You should know for sure who the audit firm is. That's another area that I've seen a couple of plans in Texas get in trouble is they invested with somebody that was kind of unknown, but worse, their audit firm was unknown. Well, it doesn't guarantee success if they have a big audit firm, but at least you know that they're big enough to justify that. And you're going to have someone else helping keeping an eye on what's happening behind the scenes on your behalf. Look for conflicts of interest. There's that theme again. And then look for incongruence performing the performance and the strategy. I had somebody come through our office not too long ago, and they talked about how great they were in certain markets. But if you actually look at those markets, at their performance, it was very much not a great time for them. But if you looked at when they did successfully, it was something that was totally contrary. They were successful. It was totally contrary to their strategy. Well, obviously, if it's not consistent with their strategy, for them to be congruent, well, then you probably ought to watch and wait before you make a decision. Know what you would expect somebody to do in a positive environment and how you would expect them to perform in a bad environment. Look at their history, going back to the point of their history being long enough, and see how they've done in those environments and look for congruence. Also be wary of people who a lot of the gains they have are unrealized. That's nothing wrong with it, but at some point, people need to exit successfully. And this is a little more important in the private markets than the public markets. But in the private markets in particular, somebody talks about this great rate of return that they've achieved, but they actually haven't sold anything. That's not as good as a return that's just as equal, but everything's been realized and they have shown that they can fully exit an investment or a full cycle. So important for them to actually have realized results, not just unrealized results. And be wary of one-hit wonders, bull market geniuses, as we call them. They happen to hit the right spot at the right time. They do really, really well, but they're really not that strong underneath the surface. Be wary of just one-hit wonders and bull market geniuses. And of course, if it sounds too good to be true, doesn't mean it always is, but you better make sure it is not too good to be true, if you will. So from there, you want to know exactly what to expect from a reporting standpoint, and then hold them accountable to keep that schedule. Again, if you have in your Asana project or whatever that you're expecting your consultant to report back to you every single quarter on the 12th of the second month, and they don't, well, then either A, y'all need to reset expectations, or B, they need to get fired. Because if they said they were going to do something and they don't do it, they need to be held accountable for doing that. Talking about reporting, it needs to be consistent and it needs to be complete. It needs to be not just an asset level. It needs to be the portfolio level. How is something done over the entire portfolio? How is the portfolio as a whole done? And then, yes, the individual asset level performance also. You should have both. You should see how the peer group is performing. What is this compared? How are we doing compared to our peers? We can help a lot with that. A lot of this is on the State of Texas Pension Review Board website, but your consultant should tell you that, or anyone else that is an asset manager for you. They're a small cap manager. How have they done compared to other small cap managers? If they're in any asset class, they should be able to tell you how they're doing compared to their peer group. And if they're afraid to tell you that, it might give you a clue that you might need to fire them. You also want to see exactly how you are evaluating them compared to their benchmarks and their peers. So you should look at your plan versus its peers. You should look at an individual manager compared to their peers, and also obviously compared to their benchmarks. Small cap, going back to that example, how they done compared to the Russell 2000, how they compare to their other peer group. You should know that, and your consultant should be able to tell you that. You also should know where the fees and expenses are. Again, there are no bad fees. There's just bad return on investment for fees. One of the plans in the state, we just went through this last board meeting, has the most expensive average fee, but they also have the strongest performance because so much of the fee that they're paying is for performance. And so the better the performance, the higher the fee. Well, that's not necessarily right for your plan. Fees and our expenses, and how does that compare to our peer group? And then what does the asset allocation look like compared to the IPS, the investment policy statement? And is there any recommended changes that are there? And then evaluate folks objectively, non-emotionally, and very consistently. Once a quarter, once a 6 months, once a year, whatever your determination is, set a plan and stick with it, and you're going to be very successful. And then everybody should be evaluated at least annually. Every single person that you work with, from audit firm to actuary to consultant to advisors, every one of them should be evaluated at least annually and see how they've done compared to their peer group, and then understand what was the reason for the variation. If everybody's very consistent together, it's a lot less time involved. But if you see an anomaly, somebody's way outperformed expectations positively or negatively, just understand the reason why. It doesn't make it bad. It may be very understandable, very explainable, but just make sure you understand the reason. And then, of course, are the fees still appropriate? And have they done what they said they were going to do when they said that they were going to do it? Have they had any changes in their key personnel? Have you all of a sudden had 3 new audit partners in the last 3 years? Well, maybe okay, but you ought to understand why. If it's an investment manager, major issue. If the people that created the track record aren't there anymore, that track record doesn't add any value to you. Had they been consistent and professional in their communication? Had they educated where they need to educate? Had they informed where they need to inform? Very, very important to know how you like the way that they're working for you, because they do, and you pay them. So hold them accountable for their consistency and their professionalism. And oh, by the way, alignment is everything. Real quickly, the IPPE, it's a burden once you first do it, but it's something that it should not be a burden. It should be looked at as a structured way to encourage your regular evaluation. If all you do is a great job on your IPPE and you do it consistently, so much of what I've already talked about, you will cover and you will address those issues. And that's one of the reasons it was designed the way it is, to be able to help you have a checklist, if you will, to go by of just best practices, and certainly what the legislature asks us to report back to them for the plans in the system. And the only way that we can know in anything how well we're doing is to measure it, and to measure it consistently. The IPPE is designed to be able to do that, and it is critically important. You do not hire your current investment consultant to do your IPPE. You can't do that. Should they fire themselves? My guess is their answer is going to be no. But part of the IPPE is an evaluation of each of your advisors. And so hire an independent consultant to evaluate your current team. The same way a business would hire someone from the outside to evaluate their leadership, their service providers, etc. Do the same thing. You can, it's not wise. It absolutely raises red flags with us. If the consultant that you use is grading themselves, they're probably going to give themselves an A. Very few people give themselves an F when they're grading themselves. Hire an independent consultant specifically for that purpose. Put them on a consistent engagement. They'll know you. They'll know what's normal and customary in the industry, and they'll be able to do it very, very quickly. And I said this earlier that I'd probably come back to it. Hope is not a good investment strategy. If somebody is not consistent on their IPPE, or they just throw it together, then usually they're just hoping everything's going to work out. No, have a plan, stick to the plan, execute the plan, and adjust the plan as needed. We'll talk about that in a fun way in just a second. So when we talk about, investing, this is just my perspective as somebody who's done it for a very long time for very large pools of capital. The only free lunch in the industry is diversification. Everybody pretty much on this call understands that, but it's important you understand fully. You do not pay anything extra for diversification. You could pay significant penalties for not being diversified. Now, I want to be careful here. There is such a thing as over diversification, or what some refer to as diversification. All right. So just because you're diversified doesn't guarantee success, but it does give you less correlation, less volatility typically, and certainly the diversification to where when one thing is zigging, hopefully you have something else that is zagging. That is what Ray Dalio quotes and others quote as the holy grail of investing. That is very, very, very important. And, it's something to where you need to think about where your diversification is compared to the opportunities available to you in the marketplace and what others like you are set up as, how they are designed. So all assets will likely be an important piece of the puzzle. Public equity, private equity, public credit, private credit, real assets, infrastructure, pretty much everything for a large plan is going to need to be part of the puzzle in order to be able to get that diversification, in order to get that free lunch that is also that holy grail that Markowitz won the Nobel Prize for, is modern portfolio theory. You also want to stay flexible and be ready to take advantage of opportunities. You need to know kind of, what am I going to do if a recession comes next year? How are we going to adjust? Doesn't have to be wholesale changes, but we need to maintain enough flexibility to take advantage of market dislocations and opportunities when they occur by shifting our asset allocations around within our overall diversification. And we need to remember that a great defense is usually better and more important than a great offense. It is so much easier to recover from a 3% decline in your plan than a 13% decline in your plan. That doesn't mean you don't take risk, but you need to be aware of where your downside is. As a firm, we take this approach. What's the worst case scenario? If we can live with that, the upside will take care of itself. So more than anything else, have a plan, stick with the plan, review the plan regularly, and then improve it as you have other tools and resources and guidance to be able to do that. It's fun because it's college football season. And so I'll give you an analogy. Coaching football is not much different than managing a pension. And for some of you who tuned me out for a second, I probably just got your attention going, what does coaching football have to do with managing my pension? So what it is, just take the Alabama-Georgia game that happened a couple of weeks ago. It was obviously one of the most well-watched games that are out there and ended up being an upset. Certainly is going to set up an interesting, playoff series that we have coming up here over the next couple of weeks. But the thing about, the Alabama-Georgia game is we can learn a lot from it. The first thing is everybody knew when they started the game what their outcome was. So obviously they wanted to win the game. In your particular case, maybe your outcome is to get to 100% funded within 16 years. 100%, 16 years. If that's your goal, figure out exactly what you have to do with your sponsor, the city or municipality or whatever, with the plan, with the employees, with the retirees, whatever your plan is, you need to know what your outcome is. And if you have a clear outcome, you're more likely to hit that target than if you don't know really what you're trying to accomplish. You also are going to build a game plan of offense and defense. What assets in my portfolio are going to actually deliver really good returns for me if we have a very strong market in 2024? What's going to protect me in the event that we have a bad environment in 2024? And then you make in-game adjustments and you make the plays that work for your team. Now, in the case of Alabama and Georgia, they've got talent everywhere. But in a lot of other teams, they don't actually have talent everywhere. They may have a really good running back, but they may not have that great of wide receivers, or they may have great receivers and not that great a running back, or their line may be weak, or their defense may be strong in this area, but not that area. Call the plays that are going to give you the best chance to be successful with your plan for your team. Don't try to run the plays that everybody else runs. Run the plays that work for you. And then don't let a few mistakes or bad plays shake your resolve. You're going to not throw it again. Alabama had, if I remember correctly, 2 interceptions. Are you not going to throw the ball the rest of the game because you had 2 interceptions? Well, maybe you're not going to call that route again because it clearly is not working, but maybe you're going to do something to make an adjustment, but you're not going to lose your resolve. If you hire a manager and they don't work out, that's okay. That doesn't mean you never hire a manager in that same space ever again. Avoid never, avoid always. Don't let a few bad plays shake your resolve. And then play the long game. Don't bail on any strategy until you have enough time and data that you need to properly adjust. We know that every single person on the coaching staff of Alabama and Georgia in their respective areas, the play callers, they knew what was working and they knew what was not working. And so they gradually adjusted throughout the game to give their team the best chance to win based on their talent, their skill set, obviously situations where down in distance and field position. This is Texas. I can talk a lot deeper about football, but you need to make sure that you have the proper data to be able to adjust your strategy. And sometimes we got to do what we don't want to do. We got to make hard calls. Sometimes that means firing a staffer. Sometimes it means firing a manager. Sometimes it means firing a consultant. Sometimes it means asking a board member to step aside because they clearly aren't taking it seriously. Is that fun? No. Neither is letting somebody go from your business. Neither is deciding you're going to make a change to personnel ever. But sometimes it's a must. And, as the saying goes in our firm, hire slowly, fire quickly. If you recognize that you made a mistake, move on. Have that willingness to make a hard call. So in closing, use the PRB as a resource. We are on your team. We want to be part of the solution, and we are here to help. We have an amazing staff. They work their tails off because they care about the people that you're serving. Let them help you. Don't look at them as an adversary. Look at them as an ally because they are here to help you. And then run your business of a pension like a business and hold your team, including your staff, consultants, and managers accountable. And the more that you run your pension like a business, it'll be more successful, higher likelihood, and most likely your people, including your service providers, and of course your constituents, they're going to be happier because they know what the rules of the game are and what's expected of them and what to expect from the plan. And ultimately, if they know that you're doing everything in the right way and you're doing the best that you can to take care of them, those constituents are going to know that you're being a good steward of their financial future, which allows them to sleep at night better, allow them to be more loyal, and stay with your system longer, whatever that system might be, if they're a current employee. And obviously, it's going to enable you to recruit and attract talent better than you have before because you have a well-run system with a good plan. And ultimately, they know that money's going to be there for them when they need it. So we obviously, appreciate very much, you participating in this. And obviously the Q&A, is there. I'm looking and waiting for people to ask questions. There's been a couple of them, early on, and looks like we had a little bit of questions that came through, but most of them I've answered. I'm looking at the list now and I'm not seeing anything that I haven't. Robert, is there anything that you'd like me to touch on? I can go through a couple of common questions that I hear, but I want to make sure this is about them and about their time, their questions.
I think some questions that systems have is, when they start looking into new investment managers, I think some of the things that they have about is there anything that they should really look out for that can help them narrow down that field of potential professionals out there that they should be looking at? Is there like any one particular thing that you would start off with at like the top of the list to help you start narrowing down who are those potential investment managers that they should look for?
So the first word that I would focus on is persistency, right? If somebody had a great fund one, I'm going to talk in the private markets for a second, a great fund one, but they had a lousy fund two, a good fund three, and an off the charts fund four, that doesn't make them a bad manager, but you better understand what happened to fund two. So persistency is the first place that I would look. We look as a firm at 1,500 investments every single year. The first thing that we're going to look for is persistency. The second thing we're going to look for is just viability. Are they new? Are they fresh? We have a fun phrase, are they a PowerPoint in a garage, or have they actually been there, done that, and done this over a long period of time across market cycles? But the other thing that I would say is, what's the edge? In the world of managing a pension, if there's no edge, index it, right? It's going to be cheaper. It's going to be easier. It's going to be more efficient. It's going to be easy to track, index it. But if you can find somebody who has an edge and they can add value and they can give you a good return on investment for the fee, well, then you should hire them. But you need to know what that edge is. Are they a domain expert? Do they really, really understand one particular sector? Do they have an expertise in certain times of the economic cycle? Like they're really good at distressed, or they're really, really good in international and in particular region. What is it that makes them different? And literally, you can ask them and say, okay, and I'm being a little blunt sometimes, but we've looked at 5 managers that look like you, sound like you, talk like you. They all went to good schools. They say all the right things. What is it that makes you different than every one of them? Because I can't seem to figure out the difference between you. And again, that you don't have to be as direct as I just was, but ask them the question, what makes you different than everybody else? And tell me how I should expect the extra fee that I'm going to pay you for your skill to translate in returns. So expertise, a true edge, and then persistency. If people don't remember anything else, those will serve you well if you focus on those 2 areas. Another question that I get asked all the time is, because it is a hot button right now, is we obviously focus as a PRB on trying to make sure that expenses are as low as possible, unless there's returns to be commensurate to what those fees are. And so literally, I had somebody the other day ask me, should we just stay away from anything that has a performance fee? And the answer is no. But you better get the performance to justify paying that higher fee. Don't just accept mediocre or average performance at a higher fee. There are several very high profile cases here in the state where they had enormously high fee structures and expense loads, but they were getting like terrible performance. So if you look back over the last 3 years, and again, it should be over a full cycle at a minimum, 3 years, 5 years, 10 years, whatever you're based on the history of a plan. If you look and see that you have averaged, 50% higher fees than everybody else in the industry, or in the pension world in the state of Texas, and your returns are the same as everybody else, well, it ain't working. You shouldn't be paying 50% higher expenses if you're getting the same results. Just the same is if you're 50% less expenses and you're getting the same results as everybody else, you probably got to go to your board and ask for a raise, because you're delivering excellent results and you're getting a better return on investment for the fee that you are, paying to third parties, or your expense load. So we're working on it at the PRB, a matrix system to be able to see, okay, obviously everybody wants to have low fees and high returns. And so that's top left, and low fees and low returns, that can be okay. High fees and high returns, that can be okay, but nobody wants to be in the bottom right quadrant, which is you have very, very high fees and lousy performance. So we want to be able to look back and give you those tools when you complete your IPPE to be able to say, all right, great, here's where you compare to your peer group. And that allows you as a board member or as a staff person to be able to know, are we on the right track? Are we off the right track, et cetera? But don't let performance fees just scare you away from something. Make sure you're getting a good ROI on it. I'm not seeing any other questions, Robert, but if you have another one you'd like me to cover, I'm happy to. Otherwise, we can adjourn. But You tell me.
The only other question that I would think that I've heard from some systems is that for some of their alternative managers, and I don't know, I understand this can be a very case by case basis, but some of the managers can sometimes, with those profit shared carried interest or some of the fees, aren't willing to necessarily go into the specifics or as much of the detail about those investment expenses. Is there any way that you would recommend to systems to help them navigate that field if they come across a manager that might be providing very persistent good returns, but also is, they have a lot of proprietary information that they do want to keep protected?
It's interesting. Generally speaking, if somebody doesn't give you transparency, then you want to understand why. Okay. And if you can get comfortable with the why, that's fine. But really, there's not much as a person in the industry, there's not much that somebody should not be able to share that explains where expenses have come from or where fees have come from. Right? If somebody's charging you a carried interest on a transaction, they should be able to tell you, we bought it for 100 million, we sold it for 300 million, we get 20% of the profits. Therefore, we made 200 million of profits, we get 20%, that's 40 million. Everybody get that. That should be pretty straightforward. Now, there's some exceptions around that, but that's not that hard most of the time. So I would press for it. Sometimes they just don't want to, and that's okay, but you should be able to ask them to be able to provide that transparency. Again, if you don't know why they won't share it with you, you probably need to not work with that manager anymore. If they give you a good reason that you understand and you feel is a good, sound business reason, then you have to decide, is that something that you're comfortable with? But I totally 100% would encourage you to be able to get as much transparency as possible, because that's the only way you can make good decisions. There's an old saying in one of the books that I referred to earlier, bowling through a curtain is not much fun. You need to be able to see, I'm bowling, did I get all the pins? Did I get some of the pins? What do I got left, etc. Get that transparency. Most of the time they'll give it to you. As long as you have a good reason for asking the question, most firms will dig in and they will deliver that for you. So, there's a lot of other ways. There's an interesting question in here that I'll just address really quickly before we close. And that is that, okay, if you have a frozen plan, is there a way to be able to, to be able to find a solution for that maybe is a permanent solution? And I'll leave the question at that, Randy, but we can talk about it more with the PRB staff. But what I will tell you is this: it is so valuable, the relationships and the connections and the knowledge that the PRB staff and the PRB board has. Don't try to reinvent the wheel. Your consultant may know the answer, they may not, but ask us, well, who would you go to as an expert in this area? Or we're looking for, that kind of solution. What can we do? That doesn't mean that we're always going to have the answer. We may not, but we will give you we don't know, but we'll try to find out if we don't already know the answer. But because we see all plans in the state and we track what's happening around the country, a lot of times we can tell you what is the most common path that somebody can pursue in your particular situation, regardless of where you are in your life cycle, regardless of where you are in your funded ratio. Success leaves clues. And so if you are looking for success, we might have seen a model that you can copy or replicate or learn from, and we'll be happy to share that with you. So thank you, everybody, for participating in this. Obviously, thank you to the PRB staff for all the wonderful work that you do. And obviously, if I can be helpful individual in any way, shape, or form, please just let me know.